Hello everyone, welcome back to another episode of Andy's Fire Club. This episode is part of a mini-series, one of my favorite mini-series on this channel, which is called The Armchair Macroeconomist. Because face it, back in 2020 or before 2020, no one paid attention to the Fed or cared about the FOMC meetings. But now, not only do we celebrate FOMC meeting days like their holidays, but we've all turned into armchair macroeconomists, with me being the head armchair macroeconomist. FOMC, by the way, stands for Federal Open Market Committee. And basically, it's the committee of Fed presidents, including the chairman, Jay Powell, who will gather and have a closed-door meeting and then announce the next day what to do with the federal funds rate. So if you're interested, I will give you my take on what to expect from the FOMC meeting, which happened, by the time you watch this, it'll be yesterday and today. And there will be a press conference at 2:30 p.m. Eastern where Jay Powell will give a speech about his outlook and all that stuff. And the results will come out at 2 p.m. Eastern, so half an hour before that. If you're in a different time zone, you can adjust on where your time zone is. But anyways, what can we expect from the FOMC meeting? The Fed is first of all, widely expected to raise the federal funds rate again by another 25 basis points. So in case you don't know what a basis point is, 1 basis point is 0.01%. So 25 basis points would be 0.25%. So this is essentially confirmed, and I would be very, very surprised if it was anything different other than a 25 BP hike. And after today, the federal funds rate will be in the range of 5.25 to 5.5%. Now, you guys know that I've been critical of these decisions, and I've been saying that the Fed has already gone too far and raised too much. However, since I've had some time to reflect on this, although I still stand by what I said, I can see that from their perspective, why they have to raise rates even more, despite inflation coming down dramatically already. And this is because they've already promised that they would hike rates even more. So if they don't follow through with what they said, then they would be perceived as wishy-washy, as weak, and they would just lose credibility, right? Nobody would believe them the next time. So it's like the boy who cried wolf, right? The boy who cried rate hikes. If you keep saying things that you're not going to do, then eventually people stop believing you. But circling back a bit, I often get some pushback every episode when I say inflation is coming down. I always get somebody in the comments being like, oh, go to a grocery store and look at the price of eggs. What are you talking about? Inflation is not coming down. Well, what we need to be clear for the last time, I'll say this again, inflation coming down does not mean prices coming down. So those two things are completely different, and please don't confuse the two. Because inflation coming down simply means that prices are still going up, but they're going up at a slower pace. So inflation is the rate of change of prices, right? So what I'm saying is that inflation is coming down, meaning the rate of change is coming down, but the trajectory is still up, right? If it was going down, it would be deflation. So, for example, if eggs are $4 a dozen and inflation is at 10%, then this means that next year they go up 40 cents, right? They're going to be at $4.40. But then the next year, inflation, let's say it comes down. Inflation is at 5% now. So prices only go up by another 22 cents. Because 5% of $4.40 is 22 cents. So now eggs are $4.62. So you add those together. So you get how that works now, right? The prices never actually come down. They just go up at a slower pace. So let's hope that that is clear, all right? Anyways, I understand why the Fed is still raising rates because they said they will. But I still think it's a mistake. So if you go to trueflation.com, which is my go-to source for actually up-to-date information on inflation and not just CPI, which I think is horribly slow and outdated. It's a horribly slow and outdated way of measuring inflation. But anyways, if you go to Trueflation, we're at 2.5% right now, inflation year over year. which is only 0.5% higher than the Fed's target of 2%. Keep in mind as well that the slowdown effects on the economy due to rate hikes are not instant, right? So when the Fed raises rates, it usually takes about 6 to 12 months for the effects to really filter through to the consumer and for you to actually see it in terms of everyday goods and services prices. And why is this the case? Well, remember what the federal funds rate is. It's a rate at which banks can borrow money from the Fed. So if the federal funds rate goes up, then banks are less willing to borrow money, and they may also have to pay more interest on existing debt that they already have. So in turn, they will become more strict when it comes to lending money to businesses and individuals, or just charge businesses and individuals a higher interest rate, which causes them to kind of be more careful in terms of borrowing money and slowing down the economy as a whole. But as you can probably deduce, it takes a while for this effect to filter through to the everyday consumer, where the everyday person, the average Joe, can feel the effects. So it has to work its way through the system. So that's why I'm against further rate hikes, because I think that if we raise now, we won't feel it for another 6 months from now anyways, where the economy might be weaker. And even though it's only 25 basis points, it might make the difference between another major bank going bankrupt or something like that, right? So that's just my opinion, though. From my armchair macroeconomist perspective, I don't have a PhD in economics or anything, so you can argue, what do I know, right? And you'd have your side of the argument on that, and you'd have some merits. But anyways, that's just my opinion. I think we can agree that the Fed was too slow on raising rates in the first place, and they allowed inflation to get out of control. So that was a mistake. I think everybody agrees on that. But I think that they're going to make the same mistake, but on the opposite end. So they're going to pause the rate hikes too slowly. They're going to rate hike too much, and then that's going to cause real damage to the economy. Another story that may have slipped through the news feed today, I'm not sure if you're paying attention, but if you were, you would know that another bank has failed, or another bank has folded, sort of. And I'll explain what I mean. Right, so Pacific Western Bank, or PacW as their stock ticker is, reported their earnings, and the stock crashed 27% in a single day, only to announce that they're being bought out by another bank called Bank of California, and the stock surged back up to where it was before. However, make no mistake, I'm counting this as PacW folding, because it's quite clear to me that they were forced into this deal and they had no other choice. So you wouldn't suddenly announce a merger when people are still on edge about the banking crisis, where two banks had already failed before, unless there was, again, no other choice, right? So here's another sign of the precarious position that American regional banks are in. And I think that the Fed raising interest rates, I think we all agree that that's what caused Silicon Valley Bank to fail, which in turn triggered this kind of domino effect, this bank run on regional banks, which led to this banking crisis that started in March, and I would argue we're still kind of going through. But lastly, I did want to speak a bit too about tech earnings so far. So we're still waiting on Meta, and that will be out later today after the market close. But Microsoft and Google had already reported, and I gotta say, both were really impressive. Even though Microsoft stock is down after hours, in my opinion, they actually did really well, and they beat expectations. But I think they just went down because people had super high expectations, even more than the kind of official analyst expectations. And a lot of the run-up had occurred even before the earnings came out, just throughout the past few weeks or so. I also had a brief look at Visa's earnings, and Visa is considered kind of a great bellwether for the economy because it tracks kind of consumer spending and all that stuff, right? And I gotta say, so far, I'm not seeing a sign of a recession. Visa did well last quarter, and people are still spending, or at least here in like Canada and America, people are still spending. I don't know about elsewhere. But Visa does the majority of their business in the U.S., Canada, and like to an extent Europe as well. But yeah, apparently people are still spending. So take from that what you will. The only bad earnings was from Snapchat. And to be honest, I've never been a big fan of Snapchat. I don't even have a Snapchat account. I think that Snapchat has always been a kind of loser. I'm talking about the stock. I don't know about the social media platform. Again, I haven't really used it. I tried it. I didn't really like it. Yeah, I just remember a while ago, they did have a disastrous app update. This was like actually years and years ago, but I think that that was so disastrous that I still remember it now because I had a lot of friends who were on Snapchat and it was kind of just a universally hated app update. And a lot of people left and they never went back. I think they squandered some great opportunities there. But thankfully, unless you are a Snap shareholder, in which case, rest in peace. But otherwise, I don't think you really need to be worried because the bad performance of Snap wasn't enough to drag down other stocks. And I think that a lot of people recognize the struggles of this company are isolated to this company alone, and it is not a reflection of the macro economy. In the very short term, I don't see a recession, as I said. Visa earnings are still good. Tech earnings are still good. A lot of people are calling for a recession, though, and I just don't think that will happen. Because I think that that's a giveaway that a recession is not going to happen, right? When everyone's calling for a recession, because usually recessions happen when no one's expecting it. So if everyone's calling for a recession, then usually that means that there won't be a recession because by definition, recessions are kind of just unexpected and they hit suddenly. Anyways, that's my 2 cents. I'll be watching the Jay Powell speech. And if there's anything exciting or unexpected that's said, I'll be sure to keep you guys in the loop. So thanks for watching this video, and I'll see you guys in the next video. Thanks.